In this video, we are going to discuss about following incomes which are taxable under the income from other source only if they are not taxable under the head PGBP. So that is the condition. So that person has to satisfy when it is taxable. Only on satisfying this condition it is taxable. Otherwise, it is not taxable. So interest on securities and interest on bank deposit with companies. Now, this we will discuss in the later part of the chapter. But right now, it is for understanding. I am saying that if it is not taxable under the head PGBP, then it is considered as income from other sources. Employees' contribution to PF and SAF, etc., received by employer if not remitted before due date. Now, whatever contribution received by employer from employee, then it is the duty of employer that he has to transfer that amount before due date into employee's account. So if it is not transferred, then it will be treated as an income of other source if it is not taxable under the head PGBP. Now, income from letting out of a hire plant, machinery and furniture. Obviously, if he is not doing the business of hiring or letting out of plant, machinery and furniture, then it is considered as income from other sources. And this is very important. Next point, income from letting out when letting of building is inseparable. This is a very important word, inseparable from letting of plant and machinery or furniture. That means if building is let out with plant and machinery or furniture and two lettings are inseparable, then it is considered as income from other source if it is not taxable under the head PGBP. Now, so when it is separable, so then it is very simple. If you have let out only building, and then it is taxable under the head income from house property because it is a building. But if you have let out building and plant and machinery and two lettings are inseparable, in that case it is taxable under the head income from other sources. So here this word is very important that you have to keep in mind. Some received from Keyman insurance policy, including bonus, if received by any person other than employer and employee. If any sum received under Keyman insurance policy and the receiver is not the employer and employee, then for receiver that amount is taxable under the head income from other source if it is not taxable under the head PGBP. Now, insurance and commission, income from royalty, all these are the income which is taxable under the head income from other source, but only on one condition if it is not taxable under the head PGBP. Now, next one important point is dividend income from other sources. Continue करते हैं. What is the basis of charge of dividend? Dividend received from any company, domestic or foreign, is taxable at a normal rates of tax slab rate in the hands of a shareholder. That means whatever tax slab, 10% or 20% or 30%, whatever tax slab or tax rates is applicable to that person, the dividend is taxable under this tax slab rate, tax rate. That means now, before some years, dividend is exempt in the hands of shareholder under section 30 subsection 34, under section 10 subsection 34. But now that exemption is removed, now dividend are always taxable under the head income from other source, where whether shares are held as a stock in trade or as investment also. So that is why now you have to remember only one point: dividend from any company, whether it is Indian company or foreign company, domestic company, it is taxable in the hands of shareholder, the person who is receiving it. Now, next important point that we have to discuss here: casual income, winning from lottery, etc. Section 56, subsection 2 IB. It includes casual income in the nature of winning from lotteries, crossword puzzles, horse races, card games, and other games of any sort, gambling, betting, etc. So these are the examples of casual income, and it is also taxable under the head income from other sources. Now taxable at 30% plus surcharge if any plus 4% higher education says on tax under section 115 double B. Now that is not important right now, but it is taxable at a flat rate of 30%. No deduction of any expenditure is allowed from such income. That means no other deduction. Let us say if you have won income of rupees 5 lakh from the lottery. Now to claim that lottery amount, winning amount, you have spent expenditure. You have incurred expenditure of 20,000. So whether this 20,000 is deductible from winning amount, answer is no, because it is clearly said in the section 56, and it is allowed 15, 58 also cover this point. That means what, whatever expenditure incurred to recover the casual income is not deductible. Deduction under chapter 6a is not allowed from such income. So that means chapter 6a deduction is also not allowed. Adjustment of unexhausted basic exemption limit is not permitted against casual income. So that means if any unexhausted basic exemption limit is not permitted, adjustment is also not possible. That means you can't do anything, any kind of adjustment, any, you can't claim any type of deduction, or you can't claim any type of expenditure from casual income. So whatever income you are getting, that is taxable at a flat rate of 30% plus SC plus SHEC. Now next one, interest received on securities. Section 56 subsection 2. Securities held as investment, interest from such security is taxable under the head income from other source. Securities as a stock in trade, interest from such security is taxable under the head PGBP. Now see the difference. If security is held as an investment, then it is taxable under the head income from other source. But if securities are held as a stock in trade, then whatever interest received on those securities is taxable under the head PGBP. So this is the difference, whether it is held as a stock in trade or it is held as a investment. So these are the difference. If it is held as an investment, then it is taxable under the head income from other source. If it is held as a stock in trade, then it is taxable under the head PGBP. Now, grossing up of winning from lottery interest on security. So, let us say if net amount is given, if net amount is given, that it shall be grossed up. Now, what you have to do? You have to find out the gross amount, and tax will be levied on gross amount. So, gross amount is equal to net amount 1 minus tax rate. So, that is the formula for grossing out the value. You can also put one formula for that also. Let us, I am giving you one explanation related to this to give you a better understanding. Like if you have received net amount or of 21,000 after deducting 30% of tax. So by this also you can apply the formula 1 minus 0.30, you can do it, and you can find out the gross amount. Or you can also put that, let us say 100 rupees is the, you have to assume 100 rupees is the gross amount minus tax rate is 30. So what is the net amount? So this is net amount 70, this is gross amount, and this is tax amount. So put the equation, if 70 is the net amount, so gross amount is 100. So what will be the gross amount if net amount is 21,000? So 21,000 into 100 upon 70, so you will get 30,000. So by this way you have to find out gross amount, and you have to tax the gross amount, not the net amount. Now, exceptions. Following interest income would be exempt under section 10 subsection 15. So these are the different incomes which are given exemption. So first one, interest on post office saving bank account is exempt from tax only to the extent of individual account 3,500 and joint account 7,000. So that you have to keep in mind how much deduction is available in case of post office saving bank account. If you have an individual account, then in that case you will get exemption of rupees 3,500. But in case of it is a joint account, then 7,000 is allowed as a deduction. Like if he has a account in post office saving bank and then if he received 15,000 as a interest and he has an individual account, in that how much is allowed as a deduction? 3,500. So what is now taxable? So balance is taxable. So 11,500 is the taxable amount. Interest payable to any foreign bank on deposit made by it with scheduled bank with RBI approval. It is also exempt under section 10 subsection 15. Interest payable by public sector companies on bonds and debentures notified by central government in the official gazette. So interest from the following bond is exempt: India Infrastructure Company Limited and tax-free bonds of Indian Railway Finance Corporation Limited, IRFCL, NHAI National Highway Authority of India, RECL Rural Electrification Corporation Limited, and Housing and Urban Development Corporation Limited, then Power Finance Corporation, Jawaharlal Nehru Port Trust, Dredging Corporation of India Limited, Ennore Port Limited, and Indian Renewable Energy Development Agency Limited, Government of India on deposit made by employee of CG and SG public sector company in accordance with the notified scheme of money due to him on account of this retirement. So this is the list that on interest received on these securities is totally exempt. Now Bhopal gas victims, so interest on deposit made for benefit of victims of Bhopal gas disaster in account with RBI or any public sector bank notified by central government is also exempt under section 10 subsection 15. Interest on gold deposit bond certificate issued under gold monetization scheme 2015 also exempt. Interest on bond issued by local authority, state pooled finance entity notified by central government. Interest from tax free pooled finance development bond exempt under section 10 subsection 15. Then interest received by non-resident, resident but not ordinarily resident from deposit in offshore banking unit referred under section 2U of the Special Economic Zone Act 2015. So Special Economic Zone Act comes in 2005, not 15, made on or after 1st April 2005. Interest receivable by non-resident from unit located in IFSC, irrespective of money borrowed by it on or after 1st September 2019. That means these are the different securities which are exempt under section 10 subsection 15. So thank you very much. This is all about interest, casual income, and some other income which is taxable under the head income from other sources if it is not taxable under the head PGBP. Now in next lecture we are going to discuss about gift provisions.